Are you concerned that this global coordinated central bank action has made us all a little bit too complacent?
So we'd see the change in central bank policy this year has been the key driver of this rally in risk assets, this decline in volatility, not just in equities, but really in all risk assets. And it started with the Fed's U-turn. But as we've heard, you've seen that being followed by indications of more dovish policy in Europe, in Asia, notably in China, actually, as the Fed's change in stance took some pressure off the currency, and that's led to this significant risk rally. Now, in the near term, by which we mean the next few months, we think we're in a favorable environment. It seems very unlikely we're going to get any change in Fed policy, and that policy is going to remain loose globally for some time to come. And that creates a tailwind for markets, and I think suggests investors should continue to be broadly risk on, have exposure to risk assets. But we're now at a point where investors have to be increasingly selective. We've seen this decline in the VIX, we've seen this decline in market fear broadly, and we have to be wary of any complacency creeping in. So when we look at central banks now, for example, the market is priced for the Fed to make no change through the rest of this year. The market is now priced for much easier policy across the board, and we think that's broadly right. But when we think about where the risks are to that consensus, then the risks are still that the Fed, the next move from the Fed is still more likely to be up than down in our view, albeit that's likely to come at the end of the year. So some signs of complacency creeping in. What that suggests is selectivity within investment, but what we're not seeing is any signs of euphoria in the market
Right.
today.
What does it mean for currencies, Richard?
Well, our view is that you're starting to see carry becoming the key driver of markets again, and carry has suddenly become an important driver, not just of emerging market currencies, but everything. And so if we look at the dollar, what's really notable, interesting, is that the dollar's been actually rallying against the euro, rallying against the Japanese yen since the beginning of this year. Why is that? Because actually, compared to those currencies, the dollar is the high-yielding currency. So you're seeing flows going into the dollar. But actually, compared to emerging markets, you're seeing actually flows coming out of the dollar into emerging markets, and that supports EM. So, one of the reasons we still think that emerging markets is one of the places you want to be taking risk is because of currencies and increasingly looking at to run further.